Welcome to the research desk.
Good to be here.
So, Meta Platforms. It's currently trading at $613.71.
Right.
Which carries this just massive, $1.55 trillion market capitalization.
It's huge.
Yeah, it really is. And it's sitting exactly 22.2% below its $796 all-time high.
Yep.
So here is the multi-trillion-dollar question we have to answer today. How do you, actually price a company that is printing cash like a monopoly of the present, but aggressively spending capital like a desperate startup of the future?
It's the ultimate paradox, right?
Exactly. The core tension we are examining emerges directly from this dichotomy in the data. On one side, you have Meta's elite fundamental profile. We're talking about pristine metrics, specifically its perfect 4 green walls and a staggering 82% gross margin.
Which we'll get into, yeah?
Right. So does that underlying strength justify immediate accumulation of the stock? Or, on the other side, does the fact that the technical trend signal remains decisively closed at $614 demand, strict, unwavering patience?
I think it's the latter, absolutely.
Well, I look at Meta's current setup, which is characterized by an incredible 23.8% revenue growth and elite capital efficiency. And I see absolute proof that the company is an exceptional stage 3 compounding platform.
Okay, but
In my view, this 22% drawdown is not a structural breakdown. It is a temporary valuation reset. It is providing investors with a genuinely rare entry point in the cycle 5, which is the era of AI infrastructure and wearables, long before the broader market fully prices it in.
if they can execute.
Right. But when a trillion-dollar company is compounding its top-line revenue at nearly 24%, the fundamentals are the leading indicator. The technicals will eventually follow.
See, I come at it from a completely different way. My perspective is rooted heavily in risk management, market psychology, and, frankly, historical precedent.
Sure.
While I fully acknowledge the formidable margins and the cash generation, it's impressive. Entering this stock before we see a definitive trend confirmation at $691 ignores the massive execution risks inherent in birthing an entirely new narrative cycle.
You think the risk is that high?
Absolutely. We are watching Meta engage in heavy AI infrastructure spending without an immediate, clear path to monetization. That exact dynamic could easily trigger a violent reversion to the market skepticism we all witnessed during the brutal 2022 crash.
The metaverse crash.
Exactly. The market requires hard proof of capital return, not just a grand strategic vision. Until the price action actually confirms the narrative by breaking above 691, the vulnerability to a failed breakout remains exceptionally high.
Well, to resolve this tension, we have to start at the absolute foundation. We really cannot talk about technical breakouts without first unpacking the fundamental bedrock of the company.
Let's do it.
So, for those who might not be intimately familiar, we evaluate the fundamental health of an asset using the Damodaran framework, Valuation. This framework is essentially a stress test for a company's financial soul. It evaluates 4 distinct pillars, or gravity walls, which are revenue growth, operating margins, capital efficiency, and valuation.
And Meta's score is?
Meta currently scores a perfect 4 green, 0 yellow, and 0 red.
Which is incredibly rare.
It is. So let us begin with wall 1, which is revenue growth. It is decisively green. Meta is currently posting 23.8% revenue growth alongside 10.7% earnings growth.
Yeah.
We really have to pause and unpack the sheer rarity of this metric. We are looking at a $1.55 trillion platform compounding its top line at almost 24%.
It is almost difficult to wrap your head around the math of that, honestly. Because when a company is doing tens of billions of dollars a quarter, the law of large numbers dictates that growth should naturally decay.
Right, it has to slow down.
Exactly. Finding 24% growth on a base that massive requires pulling in billions of net new dollars every single cycle.
Exactly. And that completely shatters the lazy, pervasive argument that has shadowed Meta for years.
Which one?
The idea that it is just a mature, ex-growth advertising utility facing terminal decline. People love to say, oh, Facebook is dead. Only older generations use it, completely ignoring WhatsApp, Instagram, and the underlying ad network.
That is true. They do ignore the ecosystem.
Meta is currently operating with the growth velocity of a mid-cap software disruptor, but doing it with the absolute scale of a global monopoly. A highly illustrative analogy here is Alphabet back in 2017.
Oh, that's an interesting one.
Right? If you remember that period, Alphabet was viewed by many institutional investors as a great business, sure, but one that was saddled with increasing regulatory baggage and a mature, deeply penetrated search monopoly.
Right. The consensus was that Google had squeezed all the juice out of the desktop search lemon.
Precisely. They were viewed as transitioning into a slow growth of value stock, but what the market missed was the underlying mechanics. Mobile search improvements were compounding quietly, and the rapid scaling of YouTube's monetization was just beginning to hit its stride.
Yeah, YouTube was a monster hiding in plain sight.
Those two factors kept Alphabet's revenue growth pinned about 20%. And because the top line refused to decay as the models predicted, the market was ultimately forced to re-rate Alphabet.
They had to stop pricing it as a simple, mature search engine.
Exactly. They started pricing it as a broad AI and infrastructure platform, which led to a massive multi-year advance in the stock. Meta's growth profile today sends the exact same message to the market. Immense scale has not killed its capacity for rapid expansion.
Okay, I agree that the Alphabet analogy is potent for Walt 1, but revenue growth is only half the story, isn't it?
How so?
Because fundamentally, anyone can buy revenue growth if they are willing to discount heavily enough.
Well, sure.
You can always boost your top line by slashing prices, running unprofitable marketing campaigns, or acquiring low-quality users. What makes Meta's 24% growth terrifying to their competitors is that they aren't discounting at all.
No, they definitely aren't.
Which brings us naturally to Wall 2, operating margins. Wall 2 is also definitively green. The numbers here are undeniably elite. We're talking about an 82% gross margin and a 41.3% operating margin.
It's just massive.
This proves mathematically that Meta is not buying its top-line growth through aggressive discounting or low-quality revenue acquisition. Instead, they are utilizing the extreme, almost unprecedented scaling efficiency of software distribution and automated ad auctions.
Let's actually pause on automated ad auctions for a second, because I think it is crucial to explain how that mechanism actually generates an 82% gross margin.
Yeah, let's unpack that.
Because people hear advertising and they think of like Don Draper, ad agencies, and manual media buys. Meta's system is entirely different.
It is an algorithmic marketplace. Think about the physical mechanics of a traditional business. If you manufacture a physical product, every new item you sell requires raw materials, factory labor, and shipping.
Your gross margins are physically constrained.
Exactly. Meta operates a digital auction house where millions of advertisers are constantly bidding against each other in real time for human attention. When a local bakery in Chicago bids against the national apparel brand to show an ad to a specific user on Instagram, Meta's algorithm instantly calculates the winner and serves the ad in milliseconds.
And the marginal cost for Meta to deliver that specific digital ad, the electricity, the server compute, is effectively zero.
It is the ultimate toll bridge. The advertisers bring the money, the users bring the attention, and Meta's software simply matches them at virtually zero marginal cost per transaction.
Exactly. And the analogy that best captures the power of this specific margin dynamic is Apple in fiscal 2021.
Okay, explain that one.
During that period, Apple achieved gross margins in the low 40s and operating margins in the high 20s. For a hardware-centric company that actually has to build physical phones and laptops, those margins were phenomenal.
Unheard of for hardware, yeah.
Right. The market rewarded Apple immensely, expanding their multiple, because investors realized that those premium margins were reinforcing a locked-in ecosystem. Consumers weren't leaving iOS, so Apple could dictate pricing.
And Meta has that same pricing power.
Meta's margin profile is structurally even stronger at the operating level. They have the ecosystem lock-in of Apple, but with the zero marginal cost delivery of pure software.
Yeah, it's a beautiful machine.
But, and this is a massive but, we must seamlessly connect this to Wall 3, capital efficiency. because margins in isolation, sitting on an income statement, do not tell the story of capital allocation.
Right, what you do with the cash matters.
How you generate the cash is one thing. What management decides to do with that cash is where the real risk lies.
Well, Wall 3 is also green. Meta boasts a 30.2% return on equity and a staggering $23.4 billion in free cash flow.
Yes, it is green. However, if we are evaluating the psychology of the market right now, we must explore the intense tension between that $23.4 billion in free cash flow and Meta's highly aggressive, some would say unprecedented, spending on AI infrastructure and compute.
The NVIDIA chips.
Yes. They are purchasing NVIDIA H100 GPU clusters at an astonishing rate. We are talking about tens of billions of dollars being deployed into data centers. The historical parallel here is NVIDIA in 2023.
Right.
There was a distinct moment, a psychological shift on Wall Street, when the market stopped viewing aggressive capital expenditures as a mere cost, a drag on the bottom line, and started treating it as strategic capacity.
Right, NVIDIA was generating explosive cash flow from early AI chip sales, and the market realized they could self-fund their massive research and development expansion without taking on debt.
Precisely. And Meta is currently attempting to replicate that exact dynamic. Mark Zuckerberg is trying to convince the market that their massive infrastructure build-out, buying all these GPUs to train the next generation of AI, is fully supported by their core advertising cash flow. He wants investors to see that Meta can fund the future without needing dilutive equity issuance or punishing debt loads.
I see why you think that, but let me give you a different perspective on how the market is actually pricing that infrastructure spend.
Okay, let's hear it.
Because I think the market is being incredibly cynical right now, which brings us to Wall 4, valuation. This wall is also green. Right now, Meta trades at a 17.1 times forward price-to-earnings ratio, with a price-to-earnings-to-growth, or PEG ratio, below 1.
Which is cheap.
It's incredibly cheap. Think about the cognitive dissonance here. If Meta is truly spending so aggressively on AI compute that it terrifies the institutional market, isn't a 17.1 times forward PE actually pricing in an expectation of utter failure for their open-source large language model strategy?
How do you mean?
Look, a 17 times multiple for a tech monopoly growing top line at 24% is an insult. It is a value stock multiple. It implies that the core business is going to slow down and that the billions they are spending on GPUs will yield exactly $0 in future profit.
You think it's overly pessimistic?
Massively. If you are listening to this and wondering why a 17 times forward PE matters, let's look at Amazon in 2015.
Okay, the AWS breakout.
Exactly. Back then, consensus drastically underestimated the earnings power of Amazon Web Services, AWS.
Wall Street looked at Amazon and saw a low-margin retail business that kept spending all its cash on servers.
They thought the servers were just to run the bookstore.
Right.
Their emerging advertising business wasn't even considered strategically relevant yet. Amazon's valuation was artificially compressed by a fundamental misunderstanding of the unit economics of cloud computing.
The analysts were valuing the servers as a cost center, not a profit center.
Once the market recognized that the earnings mix was shifting toward the highly profitable AWS, Amazon's multiple expanded sharply and the stock went on a historic run. I strongly argue that at 17.1 times forward earnings, investors today are treating Meta's AI capital expenditure purely as a drag on the bottom line, just like they treated Amazon's early server builds.
You think they're missing the optionality
Completely. They are rigorously pricing in the massive cost of the compute, but they are assigning absolutely zero terminal value to Meta's open source LLMs or their emerging wearable ecosystem. That discrepancy, pricing in all the risk but none of the optionality, is exactly what creates a generational entry point for an investor.
Okay, the fundamental bedrock is undeniably pristine. I do not dispute the 4 green walls. The numbers are the numbers.
Thank you.
However, fundamentals do not exist in a vacuum. A stock is not just a spreadsheet. It is a living reflection of human psychology and institutional memory. Fundamentals exist within the psychology of market cycles, which leads directly into the broader context of where Meta currently sits in its historical narrative on slide 2.
The market clocks.
Right. According to our framework, Meta sits at roughly 8 o'clock on the market clock, which indicates a phase 1 into phase 2 recovery. Simultaneously, it sits at stage 3, or high growth, on the corporate clock.
So how does that frame the current multiple?
To truly understand what that 8 o'clock positioning means, why the market is treating that 17 times multiple with such suspicion despite the 24% growth, we have to walk chronologically through the 5 narrative cycles that have defined this asset. This company has reinvented itself multiple times, and each reinvention carried immense friction.
It hasn't been a straight line up, that's for sure.
Not at all. Cycle 1, spanning from 2012 to roughly 2018, was the transition from a highly criticized, fumbled IPO flop into total mobile ad dominance.
Everyone thought mobile was going to kill them.
Wall Street thought Facebook couldn't make money on cell phones. Zuckerberg proved them wrong, delivering roughly a 700% return. Then, Cycle 2, from 2018 to 2020, was defined by the massive Cambridge Analytica data shock, severe regulatory scrutiny, and congressional hearings.
The delete Facebook era.
Right. Yet that panic was ultimately absorbed and then overwhelmed by the COVID-19 digital ad boom, where every business on Earth was forced to advertise online.
But then we get to Cycle 3.
Yes, we really must dwell extensively on Cycle 3, from 2020 to 2022. This was the infamous Metaverse rebrand, and it led to a catastrophic wealth-destroying 76% crash in the stock price. We cannot gloss over this violent whiplash because it is the key to understanding today's hesitation.
It was a brutal period, undoubtedly.
Brutal is an understatement. Why did Cycle 3 fundamentally break the stock? It wasn't just a broad macroeconomic pullback or a standard tech correction. It was a specific, violent investor revolt.
Over the spending.
Over the spending, yes. You had mounting multi-billion-dollar operating losses inside Reality Labs, their virtual reality division, and this cash burn was happening at the exact same moment that Apple introduced its iOS privacy changes, specifically App Tracking Transparency, or ATT.
Which was a massive headwind.
For the listener, let's explain what ATT actually did. Historically, Meta's automated ad auction, that beautiful zero marginal cost engine we praised earlier, relied on third-party cookies and tracking pixels.
Right.
If you looked at a pair of shoes on a website, Meta tracked that data across the internet and showed you an ad for those shoes on Instagram. Apple changed the rules of iOS, requiring apps to explicitly ask users if they wanted to be tracked.
And the vast majority of people clicked to ask app not to track.
Overnight, Meta's ad engine went blind. They lost the signal. So picture the scenario for Wall Street in 2022. The core ad engine has just been blinded by Apple, revenues are stalling, and instead of protecting the balance sheet, management is demanding that investors accept billions in long-duration, highly speculative spending on virtual reality avatars with no legs.
The optics were, well, they were terrible.
There was absolutely no near-term return on invested capital. The market entirely lost faith in the capital discipline of the executive team. The psychological trauma of that 76% drawdown is the exact reason the technical trend is closed today. Institutional portfolio managers remember the pain of funding visionary projects with diffuse returns. When they see Zuckerberg buying billions in GPUs today, their muscle memory screams Reality Labs 2.0.
That is historically accurate, and I agree that ATT was an existential threat. But your analysis entirely ignores the corporate rehabilitation that occurred in Cycle 4, stretching from 2023 to 2025. You are punishing the stock today for the sins of 2022.
It's not punishing, it's...
Cycle 4 was dubbed the Year of Efficiency by Zuckerberg himself. This cycle drove the massive recovery from the absolute lows back up to the $796 peak. I argue that Cycle 4 decisively proved management's ability to pivot under extreme pressure.
By firing people?
They didn't just cut cost. Though they did ruthlessly cut over 20,000 jobs to streamline the org chart, they layered operating discipline with actual hard-fought machine learning advancements.
Okay, give me an example.
Remember that ATT blindness you just described? Meta didn't just accept defeat. They used their massive server farms and compute power to build probabilistic AI models that could accurately target ads without needing Apple's direct tracking data.
Okay, that's fair.
They rebuilt the engine mid-flight. Simultaneously, they successfully monetized Reels, their short-form video answer to TikTok, shifting it from a drag on engagement to a massive revenue driver. Cycle 4 proved that this executive team actually listens to the market. They restored the free cash flow. This structural maturity ensures that cycle 5 will not repeat the reckless mistakes of cycle 3.
So what is cycle 5 then, in your view?
It brings us to the present moment, cycle 5 spanning from 2025 to right now. This is the transition into AI infrastructure. Open source large language models, specifically their llama models and smart glasses. This evolution deeply mirrors Microsoft's transition under Satya Nadella from 2014 to 2015 and its subsequent massive expansion through 2021.
Microsoft?
Yes. If you recall, before Nadella took over, Microsoft was widely perceived as an ex-growth PC-era dinosaur, completely missing the mobile revolution. But they initiated a multi-year ecosystem expansion by pivoting the entire enterprise toward Azure and cloud computing. Meta is undergoing the exact same metamorphosis right now. They are pivoting from being viewed purely as a social media utility into a foundational AI and wearable hardware ecosystem.
Hardware is hard, though.
Let us speculate on the smart glasses optionality for a moment, the Ray-Ban Meta glasses. I argue they are not just a neat, niche accessory. They are a wedge into ambient computing. The closest analogy here is Apple's AirPods between 2017 and 2020.
AirPods? You gotta be kidding me.
Yes, AirPods. Think back to when AirPods first launched. They were widely mocked. People made memes saying they looked like broken Q-tips hanging out of people's ears.
Well, they kinda did.
They were completely underestimated by analysts as a simple, high-margin accessory. But over 3 years, they evolved into a multi-billion-dollar product line, and more importantly, a platform lock-in that fundamentally changed how users seamlessly interact with the Apple ecosystem through voice and ambient Siri access.
Right, but
If Meta's smart glasses achieve even a fraction of that ubiquity, and they are flying off the shelves right now, through real-time translation, AI assistance whispered in your ear, and seamless visual capture, the market is currently completely mispricing a massive category-defining consumer hardware platform. Meta finally gets to bypass Apple and Google's app stores. They own the hardware.
I'm sorry, but I just don't buy that. Let me tell you why the AirPods analogy is fundamentally flawed in this context, and why the market is right to be deeply skeptical of that 17 times multiple.
Go ahead.
AirPods were an accessory to a deeply established, highly trusted, dominant hardware ecosystem, the iPhone. Apple already had 1 billion smartphones in people's pockets. The AirPods were just a natural, frictionless extension of a device users were already addicted to.
Okay.
Meta is attempting to build the hardware ecosystem entirely from scratch, pushing against consumers who have historically universally rejected face-mounted computing. Google Glass failed. Snap Spectacles failed. Magic Leap failed.
But the form factor is different now. Ray-Bans are...
Furthermore, your optimism is entirely ignoring the primary bear catalyst that institutional money is watching. If the massive AI infrastructure spending required to support these open-source llama models and these wearable interfaces outrun the actual monetization, if the capital expenditures spike but the ad revenues flatline, the market will aggressively punish Meta.
Well, sure, if the ads flatline.
The market will instantly revert to the Cycle 3 metaverse backlash dynamic we just discussed. We could easily see the stock dragged rapidly back down to the $480 to $500 risk zone.
But they're giving away llama for free.
And let's talk about the open source LLMs. Yes, giving away the llama models for free is strategically brilliant for commoditizing competitors' foundations. It hurts Google and OpenAI by driving the cost of AI models to zero. But commoditizing a competitor does not inherently capture economic value for your own shareholders. You are asking the market to patiently fund a multi-billion-dollar war of attrition.
Look, I completely hear you, and I concede that the trauma of Cycle 3 is exactly why the market is hesitating. It makes logical sense. Investors are demanding to see the direct translation of that GPU compute power into tangible ad revenue before they are willing to award a higher multiple.
Exactly. Show me the money.
And honestly, that hesitation, that exact psychological tug of war between the brilliant fundamentals and the hardware execution risk perfectly explains the quantitative, geometric data we must examine on our next analytical step. Slide 3, geometric order, sentiment, and the anchor signal.
Let's get into the math.
let's look at the proprietary sentiment tracking. The extreme score currently sits at 12 out of 20. This clearly indicates moderate positioning. It means there is neither panic nor euphoria in the institutional options flow. Furthermore, the stock registers a geometric order of 0, which we define as the anchor, or in historical phrasing, the narrative anchor.
Order 0.
Let us translate that geometric order 0 into plain English for a second. What does it actually mean for a stock to be order 0? It means the stock is no longer breaking down. The intense bleeding and distribution have stopped, but it hasn't established a clean, upward trending expansion yet. The price action is actively attempting to convert a former momentum darling into a renewed, stable leadership candidate, but it is stuck in the mud.
It's a transitional phase.
When we analyze the specific mathematical parameters underlying this order, the tension becomes quantitative. The sigma distance, which measures how far the price is deviated from its statistical mean, is a very tight 0.103. The slope, which measures the actual directional trajectory of the trend, is a barely perceptible positive 0.00035.
Basically flat.
Forward movement is effectively flat. But, and this is the crucial part, the acceleration is a massive 10.67, with a jerk, which in physics and quantitative finance is the rate of change of acceleration, sitting at a highly elevated 1.81.
I think we need to give the listener a physical analogy here, because jerk and acceleration in stock prices can sound like academic jargon.
Please do.
Think of a heavy car stuck in a patch of deep mud. The slope, the actual forward movement of the vehicle down the road, is barely anything, right? That is your 0.00035 slope. It's barely inching forward.
Right.
But the jerk, the sudden revving of the engine, the aggressive spinning of the tires throwing mud everywhere, that is the acceleration of 10.67 and the jerk of 1.81.
It's a lot of energy going nowhere.
In the financial markets, what that aggressive tire spinning represents is institutional money actively probing the liquidity. They are buying the dips. Every time the stock drops a few percentage points, large funds are stepping in to accumulate, revving the engine. They are probing the thesis, testing the waters, but they are lacking the smooth, persistent follow-through that defines a true, effortless breakout. The car hasn't popped out of the mud yet.
Precisely. It is a setup phase, a highly contested battleground, not a runaway trend. To contextualize what that 12 out of 20 extreme score actually looks like in practice, look at Netflix in mid-2023.
Oh, the password sharing era.
After Netflix announced their password sharing crackdown, sentiment was entirely split down the middle. It was a classic 12 out of 20 environment. Half the investors viewed the crackdown as a brilliant growth unlock that would instantly convert freeloaders into paying subscribers and drive massive free cash flow.
And the other half?
The other half feared it would trigger massive subscriber churn, irreversible reputational damage, and a boycott. The stock sat in a similar moderate sentiment zone, churning sideways, waiting for hard proof of monetization in the subsequent earnings reports.
And to contextualize the geometric order, 0, the car stuck in the mud, we can look at Tesla in early 2023. Following its catastrophic 2022 collapse, Tesla had stopped acting like a completely broken, toxic speculative asset. It began anchoring a new narrative around AI and full self-driving autonomy.
But it was a messy transition.
But that anchoring phase was incredibly volatile. There were sharp pullbacks, heavy debate over automotive margin compression due to price cuts, and intense skepticism. Tesla only transitioned into a persistent, smooth upward trend after it reclaimed key technical levels and proved the margins had bottomed. Meta is currently trapped in that exact same holding pattern. The market is weighing the pristine 24% revenue growth against the terrifying multi-billion-dollar AI capital expenditures.
But let me push back on how we use this data. If the fundamentals are truly as strong as the 4 green walls suggest, if they legitimately have an 82% gross margin, 0 debt issues, and 24% growth, isn't an extreme score of 12 out of 20 the exact wall of worry you want to climb as an investor?
I don't know if I'd say
Waiting for the sentiment score to reach an 18 out of 20 means you are buying into consensus euphoria. By the time the geometric slope aligns perfectly with the acceleration, when the car is finally out of the mud and speeding down the highway, the stock will be well past $700. The risk is completely removed, yes, but so is the outsized reward. You will miss the absolute meat of the move by waiting for mathematical perfection.
I use that exact pushback to transition to the final and most critical phase of our analysis, Slide 4, the 6 buy conditions and the specific $691 confirmation level.
Okay, let's go through them.
Disciplined capital allocation requires strict adherence to predefined buy conditions, not just unbridled fundamental optimism. We do not invest based on what a company should be valued at in a philosophical vacuum. We invest based on confirmed market mechanics. If you break your rules because the narrative sounds seductive, you eventually blow up your portfolio.
That's a strong statement.
It's the truth. Let us rigorously review the 6-condition buy checklist for this asset. Condition 1 requires 3 or more green walls on the Damodaran framework. Meta has met this flawlessly with 4 green.
Check.
Condition 2 requires a favorable market clock. Met, as it sits at the 8 o'clock phase 1-2 recovery. Condition 3 requires the corporate clock to be between stages 2 and 5. Met, it is solidly in stage 3 high growth.
Yep.
Condition 4 requires the geometric order to be 1 or lower. Met. It is currently at order 0. Condition 5 dictates a strict portfolio weight limit under 5%. Met, assuming proper sizing.
So everything's green.
But Condition 6, the requirement that the technical trend signal must be definitively open, is not met. The trend signal is decisively closed. The core resolution of our entire central tension today occurs right here.
A $691.
Without trend confirmation above the specific, mathematically derived level of $691, the stock is acutely vulnerable to a failed breakout. Why 691? Because technical levels are not just arbitrary lines on a chart. They represent the collective psychology of all market participants.
It's the exhaustion point.
$691 is the exact point where the overhead supply of trapped sellers is exhausted. If earnings quality deteriorates even slightly next quarter, or if macroeconomic advertising demand slows down even fractionally due to a consumer recession, the stock will slide back toward the $480 to $500 risk zone.
You really think it could drop that far?
The $691 level is the exact point where the market is forced to treat the 22% correction as officially structurally complete, rather than an ongoing distribution phase. Until that level is breached, allocating heavy capital is entirely speculative. You are gambling on the outcome of the mud spinning.
Well, I completely accept the technical reality of Condition 6. I am not ignoring the chart. But I counter with the overall verdict derived from the framework, which is currently categorized as watch, wait, accumulate 3 to 5%. Accumulate before the breakout. We must discuss the nuance of the ideal entry zone here. For tactical, fundamentally driven investors, starting a small 3% starter position right now in the low 600s is highly viable and logically sound. You secure a cost basis at a highly compressed 17 times multiple. You establish your foothold, and then, crucially, you only add the remaining 2% to reach your maximum portfolio weight on strength when the price inevitably crosses 691.
That's still front-running the signal.
And to be intellectually honest, what would categorically break my bullish thesis? It wouldn't just be the stock going down. It would require a sharp, fundamental deceleration in that 23.8% revenue growth, paired simultaneously with accelerating out-of-control AI spend.
Which is possible.
That specific, toxic combination of slowing top line and exploding expenses would turn my view of Meta as a fortress with optionality into a capital-intensive hope trade. But given the current efficiency of their ad auction and the way Reels is monetizing, that fundamental degradation is simply not currently manifesting in the data. The business is executing flawlessly.
That's a compelling argument, but have you considered that even at a 17 times multiple, Willfully ignoring Condition 6 is a form of fundamental arrogance?
Arrogance?
Yes. You are essentially assuming that your personal interpretation of the discounted cash flows and your belief in Mark Zuckerberg's smart glasses is superior to the collective price action of the multi-trillion-dollar market.
The market requires definitive proof that Cycle 5 will generate cash, not just strategic influence in the developer community. If the Ray-Bans face sudden adoption risk, or if new regulatory and antitrust pressures in Europe compress their core platform data collection, that 17 times multiple will compress to a 12 times multiple very, very quickly. A cheap stock can always get cheaper if the narrative breaks.
That is fair. As we synthesize this debate and transition into our summary, we must acknowledge the clear dividing line. While the fundamental walls are pristine and generating immense cash, the technical gates remain locked.
Exactly. Reflecting on the data we've covered, I keep returning to the sheer power of Meta's 82% gross margins and that $23.4 billion in free cash flow. The underlying engine of this company is undeniably a juggernaut.
It is.
The market is currently pricing this asset as if the AI infrastructure buildout will yield exactly zero future revenue streams. I strongly maintain that Cycle 5 optionality, the deep integration of open-source LLMs into millions of businesses, and the ambient computing wedge of the smart glasses is drastically mispriced by skeptical institutional analysts. At a 17.1 times forward PE, I believe the downside risk is sufficiently cushioned by the core advertising monopoly to justify early, tactical accumulation. You buy the monopoly to get the future for free.
And I reiterate the critical, non-negotiable importance of technical discipline. The memory of the 76% metaverse crash is still incredibly fresh in the institutional psyche. It was a career-ending trade for many fund managers.
True.
When a company with this kind of massive capital intensity signals a major narrative shift toward unproven hardware, you do not preempt the breakout. You wait for the $691 trend confirmation before fully committing capital, because the risk of a swift, punishing reversion to the $480 level is mathematically significant if the execution falters or if the AI monetization takes a year longer than expected. Discipline preserves capital.
We will undoubtedly continue to disagree on the precise timing of capital deployment. However, I think we completely converge on the reality that Meta's aggressive transition from a pure-play advertising utility into a foundational AI and wearables ecosystem is the single most defining corporate narrative to watch in the market today.
Without a doubt.
Listeners should closely monitor the upcoming earnings reports. Specifically, watch to see if ad pricing resilience remains strong and if management provides any early clues on open-source monetization. That will be the catalyst required to either finally breach that $691 threshold or send the stock back into the mud. This is the Research Desk officially signing off.